Yeah, I had a little break there. Um, uh, Tax shelters were it was used against tax shelters, and if you're actually designing a brand new tax shelter, 183 is something you might want to think about it because it has come back in the case law. It was Preston Olson um, that he was doing solar lenses or something like that. You'd buy this solar lens, and there actually were some horse cases which were actually tax shelters. Which, if you're gonna, um, if you're gonna do a tax shelter, um, having it be about horses is like, I can't imagine anything dumber because they're going to go after you even if they don't realize it's a tax shelter because it's horses. So it was this thing called Classic Star. Um, so the regulations came out, I believe, in 72, not all that long after the act. I mean, and one of the things about the regulations that I hadn't realized until relatively recently is that the regulations were created out of pre-1969 case law, having to do with, well, if you don't have a business, you don't get a 162 deduction. Um, and what they uh, did is say, well, here's some factors, 9 factors that might be considered when you determine whether an activity is entered into for profit. 9 factors, and um, these aren't the only factors. And it's not a matter of saying, "Oh, there's 9 factors," and you add them up, and it's 5 to 4, or whatever, and the winner wins. And no, 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 and none of the factors is more important than others. Um, that's what the regs say. The regs are issued in 72, and they're at that point in time, there's no case law under 183, no case law under these regs because they're just out. We now have, I used to say almost 50 years, and now we have 50 years of case law. The first case that I found, and I think it's probably the first one, was decided in 1974. And big picture um, of the 700 cases I've looked at, which I think is a good percentage of the total. I'm closing in on it. I'll probably never be satisfied that I haven't missed one. But I doubt that there's 1,000. Maybe there's something I'm missing. But I'm at 700, and in most of the cases, the factors may be discussed. There'll be a paragraph where they say these are the factors, but then they'll go on to talk about the specifics of that case, and they don't actually say where they came out on each factor in that decision. And then there's other cases where they discuss the factors and then they start talking about the factors and make comments, sometimes going both ways on each of the factors. and then reach a conclusion. And when I read that case, I'm not always sure exactly how each of the factors, sometimes they'll be real clear on one of the factors that, oh yeah, and then the others they'll just kind of discuss. And then there are decisions where they have a paragraph by paragraph thing for each factor. And at the end of each paragraph, they say, this factor favors the petitioner, the taxpayer. This factor favors the respondent, meaning the IRS, and or this factor is neutral. And it's really laid out very nice. And the analysis I did, I love those cases because I have the spreadsheet and I give a 1 or a -1 or a 0 or a blank for each of the factors, and then I add them up and compare that to the ultimate result. So I have those decisions, and then the other decisions, some of them you can pretty well make it out, but probably if somebody else read it and they say, no, I don't think they were really meaning that about factor 5, but I've managed to create this spreadsheet and can reach some conclusions on it. And the actual experience of the case law indicates that the things in the regs about, well, no factor is more important than the other, and you don't count the factors up, it doesn't really work that way. Where I've been able to score the factors pretty reliably, whether factor 1 went for the taxpayer, whether it went to the IRS, and then add them up. There's only like maybe 4 cases where adding up the factors that were scored doesn't agree with the outcome of the decision. I used to say there weren't any, but that was when I was only at 300 cases. And then the majority of the cases are decided on kind of on other grounds, like, well, you started this business and you never charged anybody anything. So they don't bother going through they don't bother going through the 9 factors. It's like, well, you never got anybody to pay you for doing this ever. And other times it's like the assets were so grossly overvalued, it was clear that you could never do it. And you could kind of analyze that and how that affected some of the factors, but they didn't bother because it's just, well, you bought this thing for $10 million, and there's just no way you're going to get that money back. And it's not a judgment about, and you knew that. Even you didn't think you were gonna get that money back when you did that. So it's evidence that there's not an honest objective, so they don't have to score the factors then. When you're thinking about an audit, though, the audit technique guide gives strong instructions to the agents of, you got to document these factors. The reason we're kicking, reason cases come up to appellate and we end up kicking them back. One of the most common reasons is that you haven't done the work on the factors, and you got to look at all the fact, even you got to address each of the nine factors. And they've got a spreadsheet in the technique guide. So the reality is you hope that you're not going to have to litigate, because even if somebody wins in litigation, they've still lost. It costs a lot of money, and it's pretty infrequent that you can recover that you can recover attorney's fees from the IRS. So you know, what you want is on the audit, if the agent brings up 183, you'll have answers for all the factors, and the agent will back down. and when your client's audited, you'll be giving them work papers that address everything, because revenue agents are accountants. They like ticked and tied schedules. They kind of think like accountants. They have the same training as accountants. So I really believe that at the audit level, it's accountants, whether it's CPAs or regular preparers or EAs, are the best people to represent. Although I don't know, the EAs and CPAs anyway. I'm not sure if you're an unenrolled preparer, how much you can help on an audit, but that's neither here nor there. But and that's how you really win. If you ended up going to appellate and litigating, there's ways you've kind of lost. Now, this might be something, a moment to mention that what I've learned, which isn't really written down anywhere that I know of, is that large dollar 183 cases tend to settle, and they settle at a percentage of the loss, and then the person goes back to continuing to claim the losses in the future. It's not like there was this determination that this isn't for profit. It was more like, hey, this is really in doubt, and we'll give you 80%. That's the number I've heard bruited about quite a bit. I haven't figured out a way to get statistics, but the other thing I learned is that these cases are big dollars, bigger dollars than anything that I've seen litigated, where there's been a decision. The highest decision that I've seen in all the case law, I think is a $14 million deficiency. And talking to practitioners, totally off the record, cases settle for bigger, much bigger dollars than that, on a percentage basis. So that's something to think about. I'd love to hear more from people. Again, what I'm sharing with you comes from mainly from studying the case law. I wasn't involved in a lot of 183 cases, during my career. Didn't come up that much. Type of clients that I had. It's more from my writing career that learned more about this, and now I've done a little bit of consulting in the area too. So the study of the factors is preparation for the audit, and then to appeals. If the agent doesn't gonna a good job on the factors, there's a good chance you'll, but they're still insisting, like I call them the agent from hell. I've run into this a couple of times. It's like, your client's a crook. I can't figure out why. I don't know the code sections or anything because they don't give me any training, but I'm gonna keep digging digging until I get this guy. Those again, that hasn't happened too often. It's just happened a couple of times in my career. And sometimes as I'm reading cases, it's like, oh, there's the agent from hell again. So here's the factors. Again, they say no one factor is determinative in making this determination, and it is not intended that only factors described in this paragraph be taken into account. And the number of factors indicating a lack of profit objective exceeds the number of factors indicating a profit objective, or vice versa. That doesn't matter, but it kind of does, because you won't. You'll find only a couple of cases where the score doesn't match the outcome. So we're going to go through the factors, and we're going to do it in reverse order. And I'll do do a little bit of commentary in each of them. I'm not gonna read the whole thing to you, but elements of personal pleasure or recreation, and this is all about it being a hobby loss rule. This factor ends up being argued about, and it goes back and forth, because there's some things that that seem like fun, but you can you can show that, well, it's a lot of hard work and on, and that mitigates the possible fun factor. Some of the cases, somebody will do something like their kid is involved in motocross racing, or doing show horses. You got your daughter, and she's 8 years old, and you're stupid enough to let her read Black Beauty, and now she wants a horse, and so you get her a horse, and son of a gun, she's just this fantastic rider. She goes to these shows and gets all these ribbons, so you get her a better horse, and before you know it, instead of living in a condo, you got a 10-acre place where you can have 4 or 5 horses, and your daughter's heading for the Olympics. Oh geez, can't remember. There's this thing where the horses make all these maneuvers. It'll come back. It'll come back to me. And if that's the origin of your your horse business, this elements of personal pleasure or recreation is going to be a factor against you. There was this one woman who had this business, and it was science fiction memorabilia. It was called A Wrinkle in Time, which maybe you'll recognize that. And I mean, it sounded really cool. Or there was this guy who was he was a U.S. Air Force fighter pilot, or it might have been Navy. And after he retired, he found this World War II fighter plane in Australia, and he or somewhere like that, and he salvaged it and restored it, and spent this ton of money, and he went to air shows and called himself Captain Eddie. So that was, the elements of personal pleasure or recreation was gonna count against him. Yachts, uh, racing, books and whatnot. So that's the factor. And usually the argument is it's like, no, I really hate racing the car. But it's like, I gotta recover all the money I've lost by getting that big prize. Some of the horse people will manage to be like, yeah, I hate horses, but I wanted to have a retirement income, so I went into horse breeding. So at any rate, that's one that you can spend a lot of time on. There's another factor having to do with time, and you spend a lot of time on it. That's a sign that's trying to make a profit. But then they'll use, it's like, yeah, but he's out there having fun. Financial status of the taxpayer. Again, this, like several of the other factors, it almost seems like it's a gimme to the IRS, because if you have a lot of losses and you don't have any other income, you're not, it's not going to come up. Maybe it'll come up in the future when you do have income, you're trying to use the NOL, but they're not coming after you to disallow the losses under 183 because you don't have anything. How are you living? The decisions in this one create some odd things, and we'll talk about a couple of cases where factor 8 is treated in what I think is a pretty peculiar manner. But amount of occasional profits, if any, which are earned in the case law. This generally doesn't come up all that much. A lot of the cases are about people who just lose. Not a lot of things. It's, it's a lot of back and forth. I mean, if there is a lot of back and forth, you're probably you're probably not getting hit on 183 in the first place. Now, when the discussion in the case goes on about this factor and also this factor, which is a critical one, the amount of losses, because that's what this is all about. And I mean, this is close to a gimme to the IRS. What you do on this factor is you have this tale of woe. It's one GD thing after another, and it's like you're trying to make money, but there's famine, war, famine, whatever. the big payday in many of the different types of horse business, which there's a lot of them, is to get a stud that's really good, because in most of the forms of horse, but there's thoroughbred, standard bred, various types of show horses, quarter horses, cutting horses, rodeo horses. In most of those, they can use advanced techniques of freezing semen and shipping it all over the world. If you've got a really great stud. Thoroughbreds, it's still the old-fashioned way that it has to be done. It's required that they take care of the impregnation, just in the classical manner, and which creates limitations, because the stud and the mare have to get together and be in the same room, and so one of them has to travel, and that creates complications and limitations. But from what I'm told, a stud can do 200 live covers a year, give or take. And then if it results in a pregnancy, that's great. So the mares tend to be in somewhat a little bit of a safer investment in some ways, because because you need more mares than studs, is what it boils down to. So that's a big payday, though, to have a stud that the stud has a good racing career, and but not all, and has good bloodlines going back to hundreds of years, or these things are traced, and they have a good racing career, and that's good. And now they're retired from racing, and they got this one job now, and can they actually get the mares pregnant? Some of them can't. And if given that, how do the foals that come out of them, like, it's going to take like 3 years, 4 years, and it's like, well, how do they race? Do they race really well? And then do they then produce offspring who race well? So after quite a few years after the racing career, I don't hold me to this, but I think it's they can do the second job for like 20 years or so. So at some point, they'll have their grandkids out there racing and doing good racing. Their value will end up being tremendous. That's the really big payday. But so many things can go wrong. And so that's but in all of the businesses, things change about the business conditions. In the car racing, it'll be like sponsorships is a big factor. I'm not that good on dog breeding, but presumably similar principles apply. The chance for really big payoffs in the show stuff is not as great as in thoroughbred racing. The purses are bigger there. There's all these guys on the track, and then again, in farming, it's again famine and drought and whatnot. You have all these losses. You want to have a story that explains what these losses are happened, and that'll mitigate on factor 6. Factor 5, the success of the taxpayer in carrying on similar or dissimilar activities. And the discussion on this one, uh, I've called these fudge factors. It's just a theory because I think the judges decide. My theory, which might not be correct, is that the judges decide whether this, who wins, but even though the regs say the factor account doesn't have to agree, they want it to. This factor, success of the taxpayer and other activities, ends up being one of those fudge factors. Frequently, it doesn't apply or is considered neutral, but then sometimes it'll be considered negative, and other times positive. And there doesn't tend to be a lot of rhyme or reason to it. So this is a tough one to deal with it, but it's I mean, if you can find a story of other things that your client has done where they've succeeded, then the argument will be is like, well, that's nothing like drag racing. But there's not a lot of logic to this factor. Expectation that assets used in activity may appreciate in value. This is quite important because when you're saying you've got an objective of a profit, that's a big overall thing. It doesn't mean that every year you're gonna be positive. When you think about startup companies, which these are C corps. It's got nothing to do with 183, but they go out and they raise capital and they're trying to get revenue up so that they can get to the next level. And the people who are involved in the startup aren't trying to don't expect it's like, well, someday we're going to be making a lot of money and we'll have all this money come in, and they're expecting to get bought out. And if you can show that there's appreciating assets involved, you can say, yeah, well, that's where the payday is. Given all the activities that involve farming of some sort or other, it's often the real estate. And however, there is a regulation that comes into play there, having to do with the definition of an activity. And this is a key planning point. Okay, the definition of activity. This isn't exactly the same as the activity definitions under 469, which are quite complicated. And I think the best thing about them is hardly anybody understands them all that well. And I don't know how thoroughly audited they are. But if you can have call it that's the thing that I have to, the, the, the one thing that you're doing, be part of the same activity as, as the other thing, and one's profitable and one's not, um, 183 doesn't, doesn't come up because you got you got a profitable activity there. Now, what's important here is your tax return, is like an admission. When you put on a tax return, it's like that's to say it is. So you want to make the right decision about the activity. If you can come up with a theory that this thing that you're doing is integrated with this other thing that's profitable, you don't have a 183 problem. But generally the commissioner will accept the characterization by the taxpayer. There was this lady that she was involved in designing barns, but the type of barns that you have for the horses that are worth millions of dollars. So in order to get the commissions to design these fancy barns, she had to hang out with the horse people, and who own the thoroughbreds and whatnot. And the way to do that is to get your own thoroughbred, so that you're in the owner's booths when at the races, and you can mingle with the people. So that's what she did, and she was doing quite well overall, but she lost money on the horses, and made money making the barns. It's the interesting thing about horse breeding, and there's some other businesses like making documentary films. There's a lot of people involved that are making money. It's just frequently not the people who are financing all this. They made their money someplace else. They own 7 car dealerships, and then decided they wanted to make a documentary. And the technical people and the director and all these other people, they're all making money. The thoroughbred industry, it's an industry. Kentucky really cares about it, and it's an input. In some ways, even again, nothing to do with 183, but when you talk about people doing tech startups, it's the same type of thing as people who have income from more conventional things, and well, let's do this other thing. So if you can do it, there was these guys who had a car dealership, and they tried to connect the car dealership with their horse breeding business and with advertisement, and they say, oh, we sell cars to the horse people we meet, and after all, it's both transportation, right? That didn't go over. But the activity of owning land with the hope that it's going to appreciate, that's pretty clearly related. Can be related to the farming, but there's a rule. There's a rule about that, and the thing is if you're farming or ranching, and you got all this land, and you're losing money farming and ranching, and you say, yeah, but my land is appreciating, so you got to give me factor 4. They say, does the farming or the ranching reduce the carrying cost of the land? And if it does, well, okay, then we can give you that appreciation. But if the farming or the ranching, if you look at the farming and the ranching and say, you know what, it would have been cheaper, it would have been, you'd be economically better off if you just not done anything, paid the real, paid the real, yeah, sure, that helped you pay the real estate and the insurance by, by having the thing, but you're still, you lost even more than that. At that point, then the appreciation doesn't come into factor. The other odd thing about factor 4 is, you know, if you're doing something that doesn't really involve appreciation, sometimes they'll count the factor against you and say, oh, that factor's in favor of the IRS because there's nothing appreciating. Other times they'll say it doesn't apply, or they'll say it's they'll say it's neutral. So the intellectual thing going on with the factors, and again, the factor count in principle isn't supposed to be determinative, but it still still seems to be. So it's a very it's kind of an odd argument there. Time and effort expended by the taxpayer in carrying on the activity. This usually gets a lot of discussion. You know, if there's logs, that's a great thing. But then they'll throw factor 9 at you and say, well, you're not really doing that. You're not really doing it for that. You're just out there having a good time. And so it's like, yeah, but we never ride the horses. Yeah. So, but this factor does get, a lot of discussion. Expertise of the taxpayer or his advisors. Do you know what you're doing? I mean, did you look into this at all before you did, you did it? Did you do any research? Did you learn about this? And again, the fact that maybe you didn't know so much, if you got experts on your team that do well, that mitigates that. Frequently, one of the things that will come up is, did you somehow consult somebody with expertise in making money at this activity? So if you have this great consultant about how to make your car faster, well, that's great. I mean, so you might have a better chance of winning some races, but is that really gonna make you that much more money? Have you gotten expertise from people that have know how to make money doing this? Which now brings us to the thing in the regs that ends up not being true when you look at the 50 years of case law. There actually is one factor to rule them all. It shines in the discussion. Sometimes it'll be the only factor that's discussed, and we'll get a little more to how significant it is, but the manner in which the taxpayer carries on the activity. The fact that the taxpayer carries on the activity in a business-like manner is extremely important. And this is as tax practitioners and people who do returns, represent people at audit. This is actually almost a beautiful thing, because this thing, which, as I'll show you, is the most important thing, is actually pretty much the only thing that you can do anything about. I mean, all the other factors, like the the time and the expertise, yeah, but you really can't change them. You can't change the fact that you had losses. You can't change the fact that the client has significant income. But behaving in a business-like manner, that's something that can be changed. You can either do that or not do that. And most significantly, it's the thing that you can help your client with, and you can help them do this. So you identify their exposure and you say, look, I can help you. Now, the hard part in public accounting, in my long experience, is to actually get them to pay you for helping them. That's the other step. That's where a lot of CPAs break down. You know, most in my career, I was in a large local, and the managing partner, Herb Cohen, I can remember this when I'm a junior. One of the seniors is going out with his audit bag, and Herb says, "Where are you going?" And he says, "Oh, I'm going to the XYZ dealership, and they got this and that and all that type of stuff." So Herb has to tell this person one thing. And what does he tell him? Tells him, bring back a check. And and we merged with another large local, and there's this real dynamic managing partner, and he brought in these he'd bring in these consultants, and mostly what the consultants would say is you got to get people to pay you. You should charge people more, and you got to get them to pay you. So I can't help you with that part. I was never really great at. I never got on the executive committee, and I mean, I did okay, but I wasn't the one to do this. But your clients have this need that you can show them. It's like, hey, you've been doing this thing for 3 years now, losing money, and you telling me that you really think you can make money at it, but it's time now for us to prepare to defend that, and that should be part of what we're doing when you do when we're doing your return, to prepare. And we want to do things in a business-like manner. That's very important. And the business-like manner, okay, has 5 sub-factors. And what's number one? Complete and accurate books and records. Now, the thing is, if you can get your client to have complete and accurate books and records, it's a heck of a lot easier to do their return. So it's kind of a win-win-win situation here. So even if you can't get them to pay you extra for 183 consulting, you can convince them that, look, have complete and accurate books and records, okay? And that's important now because of this 183 exposure that 183 that exposure that they have it, and whether they get the complete accurate books and records by paying you more or by somehow getting it, you'll be able to do the return more easily, and you will have substantiation for their expenses, because you can win on 183 and say, yeah, this person's really trying to do this for a profit, and lose on substantiation, which is just as bad. Yeah, okay, yeah, maybe he had all his expenses, but he can't substantiate them. The Cohen rule is of limited applicability. So you want to have that. Now, I should mention that in having complete and accurate books and records, when this gets discussed in the case law, sometimes they'll say, yeah, but the only reason they had complete and accurate books and records was to document the tax deductions. And ideally, you'll be able to show that the complete and accurate books and records are used to help you make better decisions about managing your expenses. And whether that's real or not is gonna depend on the on the business. I mean, I've got this business where I do some writing, yada yada. I was actually involved in a movie at some point, my books really don't help me make decisions. I just like trying to avoid spending money. What I learned from Herb Cohen, with his vast years of experience, is that there's these two principles in business. Money coming in is good, and money going out is bad. I mean, which sounds profoundly unsophisticated, but it actually has a significant amount of merit to it. But that's it's extremely important, and it's something you can help people. Did you carry on the business similar to the way in a manner substantially similar to profitable businesses? Now, there's exceptions to this. If you can say, well, I found this new way. I got this new idea. But other than that, you want to, how do people who make money, how do they do things? And unless you can come up with something, some sort of genius idea, do things that way. Just find out. The next one, and this is probably what saves a lot of people who have year after year after year of losses, is the change of operating methods, adoption of new techniques, abandonment of unprofitable activities. Okay. If you have a long series of losses and you're being audited, and 183 is the issue, what you want to show is that you didn't keep on making the same mistakes. You kept on making new mistakes. People, you see people craft these narratives about how they change things. Business plan, and ideally, I think in terms of preparation, you should have a business plan, but a lot of people don't have a formal written business plan. They have a way they've decided to do things, and the tax court is pretty tolerant of this. You'll see this in a number of decisions, but still you should have a plan, And advertising is mentioned, mentioned frequently. I mean, that shows that you're actually trying to get some business. We might talk a little more about the business plan. Again, I mentioned this before, but agents are still focused on the factors, and they're instructed to be focused on the factors by the new audit technique factors. You know, when it's saying, it's like, hey, you guys are sending us up these cases, and you know, this is why we're kicking them back. 9 objective factors in the regulations were not addressed. You know, so you know, and for most of us, this is where the you know the fight is going to be at the agent level, at the appellate level. Even if a case litigates, it'll tend to kick back to appellate. The opinions, which I think are valuable because you get a significant part of the story, and sometimes I'll dig into to more of the documents. It's a pain to get them from tax court. Cases that are appealed, though, you can end up. It's very easy to get off PACER all the files and the exhibits, and you can really dig into that. And I'll sometimes interview people. I've interviewed attorneys, and sometimes I'll interview the taxpayers. Sometimes I call them up, and they're finding out from me whether they won or lost, because there's a blogger, Lou Tyshoff, who follows the tax court with this incredible intensity. And as soon as the things are electronically published, he's on it, and he'll have it on his blog the same day. And I get a notice, and if it's something I'm following, I'll read it, and then I'll say, oh, this is really interesting. I want to talk to the attorney, and if I can figure out the taxpayer, I'll reach out to them. That's sometimes not that easy, and a couple of times it's like, I'm sorry, you lost, you know. But so at any rate, it's at you know, it's at the level of, well, you don't want to, if you can avoid getting audited at all, you want to win. You just want to win this. You want to win this at the agent level, and you know, or appellate. I mean, takes a, you know, the cases that actually come to an opinion. It's a long time. I put the average at about 5 years. I maybe I should study that more, but so the other thing that is mentioned in the audit technique guide, which I think I actually observed before the audit technique guide, is you know, 183 was part of the Tax Reform Act in 1969. The regulations were issued in 1972, and there's been very little change in them. You know, this is tweaks. So the entire body of case law, it says of nearly 50 years, and it is now 50 years, remains relevant today. On top of that, the regulations are based on pre-1969 case law, so it's possible that some of that remains relevant. I don't see it coming up in recent decisions. In the early decisions, of course, it is coming up because they didn't have any 183 case law yet in substantial matters. I'm going to be doing a more um, a greater analysis of that, and I don't know. I may be able to publish something. Um, so we're going to talk about the case law, and I might not cover everything that has has where there are slides. But we'll see we'll see how far we go. Um, there's some things I want to address before we run out of time, so I may skip. As I said, we've tried to make this a more compact seminar, um, but I keep adding slides without pruning them. Um, so there's a chance we might discuss them all. So the first person I want to mention, we who defend clients on 183, we've got to pay our homage to Spotswood W. Robinson III, 1916 to 1998. He's a judge. He's a circuit court judge on the DC circuit, which seems to have like a little more prestige than the other circuits for whatever reason. But Spotswood Robinson made some really important civil rights decisions. But what we want to honor him for is his opinion on Maurice Dreiser. And Maurice Dreiser, his business, so to speak, was searching for the perfect steak. Maurice Dreiser, he was what we'd call a trustafarian. Like he went to law school, but he never practiced law. And then he got involved in marginally in a lot of um, um, radio shows and that type of stuff. I'm sorry I don't have his years of birth, but he's a similar age to Spotswood Robinson there. You know, like he'd be too old to be, or he, he did. He's a guy the type of age that you know wouldn't be a World War II veteran because he was probably too old, but he might have been, but as it was, he went to law school and never practiced, and then he did this thing. He had this radio show which ended up being the basis of a TV show called The Price is Right, which was kind of famous at a time, but I'm afraid I'm getting really old now. Um, he was the heir to a fortune of it was like the biggest jewelry store in New York City, and he was one of the heirs to that fortune. And he also liked to write and speak about fine dining and drinking. He had a lot of expertise in those areas. He wrote a book about how to get treated well when you go to a restaurant, and he had this recording about drinking. I remember he made a comment about how bad he felt for the like guys who like steel workers in Pittsburgh because they don't get enough time to drink. Um, and but his big project was finding the perfect steak. He wanted to find the perfect steak, and he traveled the world going to first class restaurants, and he had this whole show he would put on. They'd bring the steak out to him before it was cooked, then he'd weigh it and he'd test it for the salinity and go through this whole elaborate procedure. And then when they finally serve him the steak after it's cooked, he had this golden knife that and it had a cut. The steak had a cut like butter, or it wasn't, or it wasn't done right. And I guess the restaurants put up with this because they get a certain amount of publicity at it. After I was reading about this guy, I actually remembered hearing him on WOR, getting in a radio station in New York City in the 60s, getting interviewed by Barry Farber, who came on after Gene Shepard. Gene Shepard, if you ever saw the movie A Christmas Story, he's doing the voiceover in that. And that was based on the stories he used to tell on the radio. Years litigated, 72 and 73, $39,000 deficiency on $50,000 in losses. And the loss history on the business was from 67 to 76, $259,000. So he's litigating for $39,000. Call that maybe 280, something like that. I'd multiply that by about 7 to get a sense. So it's pretty big dollars. And this was at the DC Circuit. He'd lost in tax court. And essentially in the tax court, they said, "You're never going to make any money doing this. Come on, this is ridiculous. You've been doing this been running around doing this for all these years, and you haven't come out with the book yet. And who's gonna want to read this book about this trustafarian trotting the globe, going to restaurants?" And Spotswood Robinson says, no. That is the wrong standard. We hold that a taxpayer engages in an activity for profit within the meaning of Section 183 in the implementing regulations when profit is actually and honestly his objective, though the prospect of achieving it may seem dim. That is the most critical concept. Again, you're an accountant of some sort, an EA or a CPA. A revenue agent is also trained as an accountant. And, we vary, but there's a tendency for us to not be that much dreamers, I'd say. Like there's a kind of common sense thing. So if you're talking to the agent, it's like, well, yeah, maybe you're right. Maybe this can't, this gift shop that's full of Spanish American War memorabilia, maybe it's not practical. But my client believes it is, and it's subjective. And that's what they're trying to do. And that's the standard. It's not whether you or I think that it's a good idea that it'll be profitable. It's whether they have that objective. And it's the Dreiser decision is one of the early decisions to do this. Now, the punchline is it goes back to the tax court, and the tax court says, "Oh yeah, geez, we're sorry, we used the wrong standard, but you know what? You still lose." You'll see this frequently in litigation, but the principle is really important. And also Dreiss is a real character, so I just love his story. So indeed, the notion that such an expectation was a precondition to deductibility pervades the court's treatment of Dreiser's claim there too. The tax court was like, "Oh yeah, By thus hinging its decision on driver's profit expectation instead of his objectives, the tax court used the wrong text. The objective, not the expectation of making a profit, to govern determinations. And that is reinforced in the audit technique guide. So, going into discussing this with an agent, you should, you should have those back there. But, you have to use your own judgment in handling an audit, how you want to bring it up. There's a lot of different styles. But it's, it's there. I sometimes look at an audit as like there's a card game called Magic the Gathering, where you each have cards, and you each will have a deck of different cards that you've acquired, and you'll play your cards against one another, and somebody will have this monster that comes out and attacks you, but then you'll have this spell that kills the monster, but they'll have this potion to do the spell. And it's extremely complicated. I'm terrible at the game. But I look at audits a little like that. You'll have this and the key in playing Magic the Gathering is partially it's knowing how to play the cards, but it's actually assembling the better deck. And you always want to go in with a better deck. You want to have more decisions and regs and everything at your fingertips to make your argument. And the Dreiser decision is a really good card. The appellate decision, not the subsequent one where they say, yeah, okay, but you still lose. Now, this is the audit technique guide. And I like what the audit technique guide says. It is not entirely clear how significant a taxpayer's profit motive must be to avoid the application of Section 183. Case law reflects great confusion as to the degree of profit intent required. So if you have somebody who's doing something because they want to do it, which in the hobby loss element, I mean, that's going to be the reality. There's going to be this, I really want to do this. Then it's like, well, yeah, but you're going to try and make a profit doing it? Yeah. Oh, okay. Well, I'll try and make a profit. And the audit technique guide says, well, it's not really clear how strong that has to be. I mean, there's an understanding that when you're doing business, you're doing it to make a profit. I mean, just about everybody I've known who's worked as an accountant has done it because they want to make money. I mean, that's, when I'm at a partners meeting with, we ended up being a regional, it's like, including non-equity partners, that there might have been 30 of us, and we had different people, a lot of different things, but we all wanted to make money. I mean, that was the same thing, but that doesn't mean that you'll do, you don't have to do the thing that maximally makes money all the time. You're allowed to have other concerns. And the audit technique guide says, yeah, it's not clear. So remember that, and that's the card to play. What's unfortunate, and you'll see this coming up, is one of the circuits, I think it's the 9th, the principle is that has to be a primary motive to make money. That has to be primary. And you know, a lot of these activities will fall down, will fall down if that's the standard that they're um, that they're held to. Um, Not accounting so much. There's been hobby loss cases about practicing law, but so far I have not found the 183 case where people are doing accounting. Um, so um, so I couldn't find any really recent wins. Now, the other thing I'm going to tell you about 183 cases is that I believe that it's best to study on winning cases with, you know, the cases where the taxpayer wins. I mean, I read all the cases where the taxpayer loses, and they're kind of amusing and they're fun, and there may be an interesting lesson here and there on it. And but there are just so many ways that people can screw things up that you can't say, well, I'm gonna find these mistakes that people made and avoid them. There's just too many of them. Uh, what you need to do is look at the people who won and emulate them. Um, as opposed to saying it's like, well, I'm going to do my thing and I'm going to avoid these errors that people made. No, you need to positively emulate them, and or if you're making the argument for your client, show how your client is like these people who won. Um, Paul Wondries, he's years litigated 2015 and 2017. This gives you an idea of how how long it takes to get a tax court decision. So basically, these are returns from 2015 to 2017. So the 2017 return would have been filed in 2018. You really don't know which return triggered the audit, you know, because um, but so the return is filed in 2018, and the IRS says, no, we don't like that. You know, they send in an order, you get audited. No, we don't like this. You go to appeals. Appeals, you know, says no, 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 and so you file it. So you end up filing a tax court petition and going through the litigation process. If you measure it from the 2015 return, it's almost 7 years before you finally have this deficient decision. Deficiency was $421,503, and you know, in recent times now, the interest rates on tax deficiencies have really gone up. And also on the 183 cases, the IRS routinely asserts the 20% penalty. Sometimes they'll let it go, but generally not. Sometimes the court will say, nah, these people they had a good account and yada yada. So Wondries um, was doing cattle ranching, and um, it was a complicated story. But the things that saved him was he hired a really strong manager, even though he didn't do it himself. And then it turned out that ranching was not really that great an idea for this land. So he switched to holding it for investment. And whether that gets you 162 deductions, that's a, you know, that's another odd question. But the fact that he did this thing that was unprofitable, but he had a strong manager, and after a while said, no, this isn't working. Let's do something else. Is why he won. You know, $421,000 deficiency, that's pretty big, you know, that's not big money for 183 cases, but it's up there. William R. Huff. This was again. This was a winner. As I said, I'm focusing on winning decisions. This guy was a big investment guy in Manhattan. Just big money finance guy. And he lived in New Jersey. And the part of New Jersey he was in isn't really that rural, but he managed to have a pretty big property. And his daughter, there's a lot of things that look bad in this case. So his daughter was a vet tech, I think, and she really liked animals. And he didn't want his daughter to be a spoiled trustafarian. So he said, maybe I'll start this business that I can get this business going, and then ultimately I'll turn it over to my daughter. It'll be a profitable business. She can make a living on it. And he came up with the idea of breeding miniature donkeys, which is a thing, I guess. And he had this other guy who was able to give him a lot of expertise on it. So he really punched that ticket, and he got audited. $134,000 deficiency in the years covered with 2013, 2014. So again, that gives you an idea. 2014, the return is due in 2015, the decisions in 2021. So 6 years. What was really fascinating about this case, besides being kind of a funny story about donkeys, miniature donkeys, he managed to convince the judge that he didn't like these things. They're these hairball things. He just thought this was going to be good for his daughter. He had gross income of over $20 million a year. So, the TIGTA is saying, well, 100 grand, and this guy's 20 million. But the ruling on factor 8, it was in his favor. Okay. And the reasoning was, it's like, this guy's making $20 million a year. He's not going to screw around and save $134,000. That's peanuts. And it's really turning, it really turned factor 8 on its head. And I thought that's kind of odd and interesting, because you'll have these cases where the guys lose on factor 8 and he's making $80,000 a year. So yeah, he's getting that. I was kind of really struck by that case. It's something to keep in mind if you have like a deep pocket client and who ends up getting caught up in this. Probably if I'd been doing his return, I probably wouldn't have. I would have encouraged him to not to bother with it, to figure out a way to keep this off his return. But that's just me. So it was a good win. It's a good, and it's something to keep in mind. WP Realty. I should check this further and go over it more. But this is the biggest this is the biggest $183 case that I think is out there. I may be mistaken there. I may be missing one. But it's $14 million decision, and it's a pretty convoluted story. It's a golf course, which that's unusual, and it's a really unusual story. In some ways, the guy kind of got screwed because he wanted to set up a golf course as a not-for-profit he wanted to bring kids from the inner city to teach them to play golf. There's odd things. It's an odd story. So probably, but he again was somebody with very high income. I don't remember from what, but very high income. And factor rate was neutral. And a similar argument as with Huff. No, he's not doing this to save taxes. They're just not that big a deal. So it's $14 million. Tell you the truth on the Huff thing. I mean, the $134,000. I've had clients over the years that would get excited about smaller sums of money than I would sometimes. I had to wonder about the Huff decision. Now it seems like I'm going far in the past here, back to 2019. But again, remember, I believe the focus should be on the winning cases. And there hasn't been a tremendous amount of 183 litigation in the last few years. And most taxpayers lose. A couple of the winning cases are a little oddball. But Lowell G. Denbeston is again, it was cutting horses, and the lesson here is about the Schedule C I was talking about before. He had a seed business, and he did the cutting horses. And he sold the seed business to his son, and then his son didn't do such a good job on it, so he took it back over. So his time he spent on the cutting horses, the varied, and in the litigation, he tried to take the position. It's like, well, I was really doing it as, it's an integrated business operation. It's all agricultural, it's connected, something like that. And the court kind of cut him off and says, the way you file your return is an admission. So, if there's an argument for combining the Schedule C activity, or S corp, or whatever it is, the 183. If there's an argument for combining it, you want to do that on the return. You don't want to be arguing that after the fact. Commissioner will generally, in the audit technique guide, Commissioner will generally accept the characterization by the taxpayers of several activities, either as a single or separate. However, the taxpayer's characterization will not be accepted if the characterization is artificial and cannot reasonably be supported under the facts and circumstances of the case. I got this friend, this guy, and he does a little consulting and he writes, but then he made a movie, okay, and he's saying, well, when I was doing the movie, I was using the same computers and communicating and doing everything. So it was one, and my books and records, everything goes, everything. It's all it's like a multimedia company, and so that's the position he's taken. If he ever gets audited, I'll let you know how he does. Dr. Richard Steinberger, the flying urologist, which I kind of find amusing, and he tried to combine airport leasing and surgery, and that airplane leasing and surgery that didn't really go together too well. you know, if you've got a practice and there's a bunch of people doing whatever the thing is, surgery or accounting or, whatever, and like one of them wants to leave on a plane, and they want to try and run through the business, it's really not easy. I have a friend who's the in charge of tax for this practice that's specialized in this one profession. They focus greatly on the profession. It's a lot of advantages because they understand the business, and they're able to consult on not just the tax but also the economics, and you build up a reputation, and usually people in any sort of profession can end up being a little clannish, and you get in with a couple of them, and you get more. Like if somebody ends up doing a couple of professional athletes, they'll have a bunch of them. At any rate, they got this one profession, and he says one of his rules is no planes, no yachts. So now again, I'm but that was again, this is another example of a losing case. I guess I could find more recent examples of losing cases for you, but it illustrates another principle. And say your client is just starting out in their new business of science fiction memorabilia or dog breeding or whatever. And they come to you and say, yeah, I'm doing all this stuff and I'm trying to make money, but I'm kind of, and I'll do what you tell me to do to make good, but there's gonna be a question about it, and should I just say, this is just personal, and not claim the losses. And quite frequently when a decision comes down and somebody loses, somebody will say, aha, look at that person. They got all that interest and penalties, and you got to stay away from these hobby losses. But then you look at somebody like James and Elaine Donahue, and you don't want to look at them in 2019 when they lost in tax court with a $30,000 deficiency. What you want to reflect on is well, let's go back to 1985 when they started fooling around with horses. And they made the decision about whether they should be doing this, reporting the losses as opposed to just saying, this is really a hobby. Well, from 1985 to 2012, they had $975,000 in losses. $200,000 was disallowed in the audit. So when you look at you can say in 2019, oh, well, they lost. And that's true. But if you look at it from the perspective of 1985, when they made the decision, should we be claiming these losses, they're still ahead. Now, whether they're really ahead will depend on what they did with the money and all, and those type of things. But it's something to keep in mind when you read about somebody losing a hobby loss case. Well, how long did they do it? Now, again, if I'm not advocating fraud or something along like that. Like you always want your client to have the honest objective. You have to be satisfied that your client has the honest objective, or you shouldn't you shouldn't claim, you shouldn't claim the loss. I mean, if, that's, kind of the ethical answer. The other thing that was intriguing about the Donahue case was in looking at factor A, it is undisputed the petitioners received a total of over $100,000 in wages and Social Security income. So, yeah, they're sheltering themselves. But Huff, who's getting 20 million a year, plus, the factor eight's in his favor. But that's 2019 and $100,000, still looking at a like a magic number. So $100,000 nowadays, it's like maybe 12 grand in 1969, which was good money. I mean, in 1975, I'm like 23 years old. If I had $8 in my wallet, I felt I was ready for anything. But anyway, this one is another loss, but it's got lessons. Eddie Kurtzel, Captain Eddie. He restored a World War II fighter. It was I think it was called a Fairy Firefly or something like that. It was an RAF plane, and the idea was he was going to take people up for rides in it because it was a two-seater plane. So he'd be the pilot, and you could pretend you were the bombardier bombing the Tirpitz, or something like that. This was a I'm sorry I don't have the deficiency on here. Sometimes they don't tell you the deficiency in the decision, but losses of over 500,000. He started in 1994. It took him 8 years to restore the plane. There are a couple of lessons here. I'm contradicting myself, and I'm showing you lessons. One, and this is something that comes up that we don't think about. Now, I'm sorry, maybe you do, but at Joseph B. Cohen and Associates, when I started in 1979, you'd have these questions about what's this person's business, what's the what's the code, and not a great deal of thought went into answering the question initially. Okay, and it's like, well, what's this guy's business? What's he doing? It's like, and no thought goes into it afterwards. Nobody thinks about it. They just copy it. They copied over from last year, which I'm showing how old I am when I say copied over. It's like you get the return back. You're looking at last year's return, you copy it over. Of course, now it's it's been entered and it's there. It's like, it's going to print. It's going to print out the business code. If in any event, you should think about these things. Okay. And it's hard to say. I'm not going to. Probably somebody could. Maybe Lou could do a course on this. I'm not. I certainly couldn't. But the business was listed as airplane leasing, and I suspect that was just to prepare it, not understand. It's like, what the hell is this guy doing? And well, let's go airplane leasing. He never tried to lease the plane. That wasn't what he was doing. That was held again. If you ever actually get to tax court and you're in court, they hold these things against you. This is an admission. He didn't maintain separate accounts. Now that's not explicitly mentioned in the business in the business-like manner, but it's mentioned in a number of the cases, and I would really insist on it. If you have a business, have a separate account for it. Now, I know that there's a lot of fancy software nowadays that can avoid the need for it. But I strongly believe in a separate account for each business. It's a little inconvenient because if it's a business in which you're losing money, you're going to have to keep transferring money into it. And if you're making money, you take money out as you make money. But it gives you a strong sense of how you're doing. And it just gives a really, it makes it easy to show a really clean audit trial. Again, I'm not a big app person and whatnot. I keep my business. I keep a separate account for the business, and like they did back in the pioneer days, I'll do a spreadsheet. I think separate accounts, and it makes doing the returns really easier. So you can use Captain Eddie as a hammer over your client to say do a separate account. The other thing is, and this is the saying, oh, what a tangled web we weave, when first we practice to deceive. He claimed it was a non-business asset for personal property tax purposes, and I think this is in California. So no, that's not a business. That's my hobby. Oof. Is that what that those things can haunt you. I've seen there were some domicile cases, where somebody says, no, I'm not a resident of this state, and then he goes to get a hunting license, and he says, yeah, I'm a resident because it's $50 less. Now, he had this argument. It's like, well, yeah, this thing's increasing in value. This is like unique, somebody's going to make a movie about World War II. Where else are they going to get a fairy firefly to fly around? Because, but he didn't get the plane valued every year. So he couldn't make men. If he'd gotten the plane valued every year, and it's just like, oh, I don't think I'm going to sell it. I don't think I'll sell it this year. I'll hang on another year. That might have made the difference. Joy Ford. She was, I don't know, this is like pop culture that I'm not familiar, ancient pop culture I'm not familiar with, but she was a singer, and she created this music venue. Her part of her plan was to make a profit off this Bell Cove, which was this music venue she created, which is to make a TV show or movie. One of the unfortunate things when you do something like this, okay, you're creating a music, you were an entertainer back in the day, famous in some circles or other, and you're creating this music venue. You're going to make all these public statements in which you're saying you're doing this because you love the music and you love the young people and all that type of stuff. And those type of statements maybe will be tried to use against you when you're fighting your 183 case. I don't think that this case struck me as not being well litigated. I remember the details, but that's the impression I got. I mean, some of these cases, the way the narrative is created and everything, you can tell that there were top-notch lawyers involved. I'm not so sure about this one. Finish Welch, I would say that this is the main card you want to have in your deck. It's $4.8 million deficiency, 2007 to 2010, and then the decision comes out in 2017. So 7 years. You know, it was an 8,700 acre ranch. The guy made a lot of money in some sort of engineer or something, and you know, made a lot of money. And this is another important principle. There's some earlier case law that says differently, but this is the rule now. They'll talk about, you're in this business, you've been doing this a long time, okay, and you've lost a lot of money, and the IRS would argue, and in some cases the courts went along with this and saying, it's like, there is no way you're ever going to make back all the money you've lost up till now. And what the holding in the Finish Welch decision is, and it's come up elsewhere, but this is a good case to illustrate it, is that's not the standard. What you have to show is that what you want to show is that you have a plan, okay, and you lost money this year, and maybe you're going to lose money in the next couple of years, but the money that you're ultimately going to make is arguably going to cover the losses from this point on. That you'll be net positive in the future, even if that projected net future doesn't make up for everything you've lost all those years in the past. That's all water under the bridge, whatever. It's relevant in saying history of losses and all that type of stuff, but you don't have to show that you have a plan to recapture all of the money you lost all of those years. It's an important principle if you have somebody who's lost, who's had big losses. Now they crafted a narrative about how we're going to make money. Well, it's like, well, where we're going to make money is Woody B. Tough over there, the horse up there. The other horse down there is not Woody B. Tough. That's for another purpose. Woody B. Tough, these are cutting horses. What cutting horses do is they work in, they have a rider, and they kind of get the steer away from its mother so they can brand it and do some other stuff we don't want to talk about. It's done, it's a reality of ranching, but it's done competitively, and it's a pretty big deal, as rodeo. Not so much in Massachusetts where I live. But Woody B. Tough was a proven stallion with lifetime earnings of $340,000. But now he's into that second career, and he's still at it. It's not a thoroughbred; it's cutting horse, which I think there's a number of breeds that can do that. And they can ship Woody's semen all over the world, and this is how they get it. That's the thing. There is an artificial mare. Apparently, horses aren't that visually stimulated. They get them going some other way. And that narrative about Woody B. Tough is won the case. So you have to, there has to be that story. I'm gonna let's see. Richard Main, on that one, he won. He was restoring 50, 55, 56 Plymouths, but he lost some on substantiation. Um, Richard Cribbs is a state decision, but the state decisions, most states follow federal principles on AGI. So they'll be using they'll it'll be the same principles. I just thought this one was great because he created this ranch where people go out and hunt deer. And when you're hunting deer, um, what's prized is the number of points on the antler. That's that's what they compete over. That's how you win glory as a deer hunter, apparently. And so they were breeding the deer to have have more points. It was a pretty good story. And he won. If I wanted to be a gentleman farmer, I'm sure enough a dumb man sitting here in Alabama was his quote. And his family only hunted on the land like 4 times a year, and they shot the normal looking deer, not the mutants. Um, so William D. Evans, and this is not actually a hobby loss case, but it illustrates the principle. If you can figure out a way to make the activity part of your business, yeah, and your business is otherwise profitable, that's a win. He sponsored his sons in motocross racing, um, and it's and that's the way that activity works. That's how you make money, is by getting a sponsor. So he sponsored his sons, and he had a concrete business or something like that. But he was able to make the case that, yeah, of course somebody's going to hire me to do their concrete because my son rides on this motorcycle and falls down in the mud all the time. You can find YouTube video of his kid, and his kid was doing really well. So it was reasonable to sponsor him. And I think it was the CPA that came up with that idea. Uh, Susan Kreil is a very important decision. It gets specifically into business plan. Um, Susan Kreil is a professor at Hunter College in New York City University system, and they're actually unionized, I think. And then all of a sudden, somewhere in there, she's making more than 100 grand. And so let's look at her return. And she's an art teacher, but she's doing her own paintings, and they're getting hung in galleries. They're getting her held in museums. Like she's world class. And but she's still she's still losing money, and say, oh, she doesn't have a business plan. And Judge Lauber in the tax court says, it's like, you don't need an economics degree to sell art, and you really can't predict. Same type of thing, can go on with horses. Her trial ended up being bifurcated between the 183 case and the substantiation of her expenses. She was kind of free, and it's like, you should give the doorman a $20 tip, because who knows, maybe one of these days he'll buy one of her paintings. And that's an attitude that you'll see a lot. Although Petition did not have a written business plan, she had a business plan and she pursued it consistently. Yeah, we're getting close here on the time. Melanuzzi, he is another horse guy, 500, $50,000 deficiency. And what he did was he partnered with his trainer, and that kind of covers the expertise point and a number of things. And he was otherwise successful in this business, and he didn't have a business plan in the business he was successful in. And they talked about the unpredictability of horse racing, so you can't really say, "Oh, this is what I'm going to do in purses this year." And so he won. This is a story that I like. I ended up being able to actually interview this guy, or it was probably email. But he's a saxophone player, and with a $20,000 deficiency, because you lose money out of it. He's an engineer or something. I think was his main business. So making more than $100,000 a year, yeah. And the person doing his return never mentioned 183 to him. Didn't prepare him for it, and he ended up he ended up like having a lawyer, and he wasn't satisfied with the lawyer. He fired him and took the won the case on his own. And by his account, he was dealing with the agent from hell. I think he didn't use anybody to represent him at the audit, although the level of money, you got to think about that. So it's impossible to make a living as a musician in rural America. That's what the agent is saying. It's like, no, you don't get to, that's the wrong standard. And he says he didn't get anywhere at appeals. I think maybe if he had representation, at least at the appellate level, it might have gone away. Now, here's the thing about when you're working on an audit. I'd have this card in my deck, okay, even though it's a summary opinion, so it's not in a formal litigation sense, it's not a precedent, but I'd bring it up to an agent. John Dalton Parks, that again, this is a good win, and part of the important part. He was a track coach, and he took this kid under his wing who ends up getting a silver medal in the Olympics, I think. But he was able to show that he consulted with people who really knew how to make money, becoming a prominent track coach. So that was a good winning case. It is a really good one to study. I'm going to skip over this, but 183 was actually a factor in the 2012 election, because Romney, I think it was his wife, had a horse in the Olympics, and his tax return was released, and there was a loss coming through from a partnership, and people made a big deal out of that. And the other picture is about the story about Romney having a dog on the roof of his car as they were driving somewhere. Amway, that's, if you have like an urban practice, where you're not going to have clients who are farming and horsing and that type of stuff, you may run into 183 with multi-level marketing, including Amway. I did a study on the Amway cases, and everybody loses because they're always listening to their upline, who's the focus is always on revenue, rather than there's no thought given to controlling expenses. That's the general hit on the Amway cases. There are some other multi-level marketing 183 cases that you'll see, but Amway was the most common. There haven't been any lately. It's been a few years since I've seen an Amway case. Peter Morton is also worth a look. It was a big deal. It was a court of claims, which is pretty unusual. $9.8 million refund claim. Cases you don't, not a lot of court of claims cases. If you if you get a notice of deficiency, you have 90 days to appeal the tax court and petition tax court, and that's what people are going to fight it. That's what they usually do. And when that happens, that stops any collection agency, stops the statute of limitations. But you have alternatives. Instead, you can pay the tax and then send in an amended return where you're essentially asking for the tax back. And if the IRS doesn't respond and it responds negatively or doesn't respond in 6 months, you then can bring a lawsuit in federal district court or the court of claims. I only had a case go into the court of claims once, and what I discovered was that it's very expensive to do stuff in the court of claims, and maybe that's changed. I don't know, but it's not a you're not going to end up there for the small timers. But Peter Morton was one of the founders of the Hard Rock Cafe, and he had a bunch of entities and whatnot. And of course, he had a jet, and he managed to make the case that the flow-through losses from the escrow for the jet, it's part of an integrated business thing, and that's how he got out of 183. However, there's a chief counsel advisory in 2017 where the IRS says, "No, we're not going to follow that." So Merrill Roberts is a messy appellate case, and what's most notable about it, I think he won one year and didn't win the other year. It was messy. It was like he won a couple of years, but not the other years. And the appellate court thought they got it wrong. But the judge in the appellate court, I think it's just Judge Posner, says we mustn't be too hard on the tax court. It felt imprisoned by a goofy regulation. So at the appellate level in this circuit, I think it's the 6th, they're saying, these regulations, these factors, they're goofy, So anyway, a couple of things, be prepared from the Audit Technique Guide. They're saying if they're going to want to really talk to the client. I mean, a lot of times we try and avoid that. So they're saying in the Audit Technique Guide anyway that they're going to push that. That's 2021. That's not ancient history, but although who knows what's going on with the IRS now. So I'm at 700 opinions now, but I did the I wanted to give you the statistics, and this was I took them at the point of having 603 opinions. Nothing's changed radically as I've added more, but of Now, when I say opinions here, there's some that well, there's some 183 things where they end up not really reaching a conclusion. It's about evidence or something. And then there's a couple about recovering litigation costs. But what counts as an opinion is the court ruling on a particular activity. So in some of the decisions, for purposes of this analysis, in some of the decisions, taxpayers had multiple activities, each of which was analyzed under 183. So I'll count that as more than one opinion. An example is F. Lee Bailey. If you remember him, he's probably the most famous trial attorney in the second half of the 20th century. He was part of the O.J. Simpson team. That's probably the last famous thing he did. But he had a big audit and a lot of issues. But there were two 183 activities. One was aircraft remanufacturing, and the other was a yacht. And he one-on-one lost in the other. So I count that as two opinions. There was a recent case, somebody had three. So at any rate, the big takeaway is where a taxpayer wins on factor one, and again, not all the 603 cases do they march through all the opinions. It's about half of them maybe. Where taxpayers win on factor one, 96% of the time, they'll win on they'll win the case. Win factor one, they win. Lose factor one, they lose. If they win on factor two, and remember, it's not, there can be an opinion on each of the factors. Sometimes the factors are neutral, or sometimes they're not relevant. But if you win on factor two, which is expertise, 80% chance that you win the case. Factor three, 79% chance that you're gonna win the case. That's time and effort. For the appreciation is 86%. The other activities, 84%. If a taxpayer wins on factor six, they win, but that's only happened twice. So it's pretty much factor six is pretty much a gimme to the IRS. Likewise, factor seven. Interesting. Taxpayers can win on factor eight and still lose. Likewise with factor nine. The big takeaway is that factor one is what's important, and the other thing that makes it important, it's the only one you can do anything about, really. It's the one where you can really help your client. So it's lucky in a way for us, because we can say, hey, there's one factor that tends to make the big difference, and it's the one factor that we can help you with. Yeah, so I mentioned WP Really. I made a slide for that. Cecile Barker is a really interesting story. This guy won on the 183 case, and it was he'd been in the music production business. Some famous groups, Peaches and Cream, and then he became a rocket scientist. And made a lot of money. And if you want to make a small fortune in doing music production. Well, start with a large fortune. So that's what he did. And he lost a lot of money doing that. There's a great story that involves Peter Thiel and Hulk Hogan that he's a minor part in. I really don't have time for that, but you could get into it. But what happened to him was um, he didn't get the NOLs from all the years that he had all these losses from this business, even though he won on 183, and it was because of substantiation. And every year stands on its own. So if your return hasn't been looked at in all these years, and then you come in and you make some money, you make some big money, and you got NOLs, well, that year where you're claiming the NOLs, in principle, you have to substantiate all those years. So you gotta have all those records. Otherwise you can't substantiate. And there were other complications with Barker. He had identity theft, so the return wasn't filed. So it ended up being that he hadn't had the records for the IRS, and so he had to substantiate to the court. It was a nightmare. Ralph Vitale was trying to. He wrote a book about legal brothels. And there's research involved. Gloria Churchman is also another case. I put that at the same level. She was a sculptor, and part of the thing was she had a profit motive, but part of the profit motive was because that would show that was a way of proving that you were successful. It's not like she needed the money to live on, I guess, was something like that. But that's a very early case. It's an important precedent. Recent decisions that Gary Schwartz, just last month, it was farming combined with ecotourism. It was a real complicated story. He lost, but treating farming and holding land as one activity. I mean, it's a complicated story, but it emphasizes the importance of Olympics. Sean Paul Palesti, this is kind of a run of the mill type of case. It's the type of things that people lose. He was gonna start this workshop with 3D printers, for kids to come in and, I don't know, hopefully not make parts for guns, but which is a thing actually. But he never sold any memberships. On top of that, he hadn't filed, so that made it worse for him. Wolfgang Frederick Kraske, he had this whole idea he was going to develop carbon-based computing and whatnot, but it ended up a lot of just conference, going, meeting up with people and talking to them, and it just, there's nothing inspiring there. Joseph Bucci is a bench opinion, and those are a little harder to spot. It's like there isn't a formal opinion published. It's just the judge delivers it from the bench. So you can get it on the tax court website, but they're a little harder to find, and they won't come up in a lot of the research services. This was 3 activities. The main one though was he wanted to have a horse in the Kentucky Derby, and he'd made a lot of money on a salt mine in upstate New York, and it provides road salt to most of the Northeast. And he made a lot of money for that, but then he wanted to get into the Kentucky Derby. And the really odd thing about this case was um, the judge, I think it was Judge Holmes, you know, I think he's a little off the wall that day. He he says, well, why do you put the horses you retire the horses and you're still feeding them and stuff? Why don't you send them to Canada and Mexico to turn into dog food? And that actually created a bit of a storm in the thoroughbred industry because that is very much frowned on. It's not technically illegal to slaughter horses for food in the United States, but they have to be inspected by the USDA, and they've not hired inspectors in a long time. So it makes it effectively illegal, but it's not illegal to export them, I guess, for that purpose. But the thoroughbred industry very much disapproves of that. So if you are serious about doing and it's kind of a clubby group. So if you're serious about having your horses be in the Kentucky Derby, um, you give them a nice retirement. You figure out a way to take care of them after their racing and breeding career is over. You don't send them abroad. And the whole thing about sending horses to other countries to get processed that way, it's a real controversial thing. It's really hard on people who get horses, you know, because they love horses and whatnot, and then, you know, they can't really afford it, so they got to sell their horse, um, and you know they want somebody who's going to take care of it, and it's really it's really a tough thing. Um, Donald Swanson was a memo opinion. It was a fishing charter. Um, I think he could have won if he'd had a CPA looking out for him. There are problems with the books and records, and still the factor eight. I mean, the guy was, you know, he's got a retirement income or something. He wasn't making a lot. You know, he wasn't making a lot of money, but factor eight still went against him. So you know, again, that's if you're looking for lessons in how to and the things to avoid, it is a pretty good one. Uh, Now I'm getting into my old slides here. Carl Gregory was an appeal of a tax court ruling, and it's about the 2% rule, which would be a total disallowance now uh, applying to the 183 deduction that's allowed. This is a yacht charter guy, and he tried to say, "Oh no, it should be an AGI deduction," and they, um, you know, he was ruled against. Leslie and Joe Carlson. That was I don't know. This is a very convoluted story. You could have seen it being a 183 case, but nah. Um, John William Sherman, the one reason I this was a doctor making surfing videos. That was his that was his business. It was kind of funny. Uh, but I highlighted this because it mentions it's appealable to the Ninth Circuit, which requires the taxpayer must establish a predominant primary or principal objective intent of realizing economic profit. So it can't be, oh, I really want to do this, and I'm going to try and make some money. So in principle, that is arguably okay, but not in the Ninth Circuit. Um, um, Michael Skolnick, it's a very high dollar horse case, and Judge Larber mentioned how much he thought that factor was important, which that made that interesting. There's William Huff again. Now I'm going really back in time. Patrick Simonelli was a law practice. And Joseph A. Galagos, I ended up, it was team roping, which is kind of like cutting horses. It's a little different. It's like two horses going out there. And this guy was actually doing it. It wasn't like he wasn't necessarily breeding horses. And I was going to write about the case, but I managed to reach him, and he told me that the tax court had the facts all wrong. So I let that pass. Anyway, that's it for this session, and I hope I've given you something useful. And you know, if you look at the beginning of this, you can see my information and contact me. And if you ask me nicely, I might send you a link to my spreadsheet. And remember, honest objective trumps realistic possibility.